Our speaker this morning is Bob Hewer. Bob is a partner with Guy Hurley, an insurance and surety brokerage in Troy, Michigan. Bob speaks widely on a variety of construction risk management topics, and you can find his complete biographical material on the conference app or in the program guide. So please join me in welcoming Bob Hewer.
Thank you, Jeff, and thanks everybody. It's a pleasure and a challenge to speak before you at the IRMI conference today. I do a fair number of presentations, but this is maybe my fifth or sixth at IRMI, and it's the IRMI presentations that I always sweat over. You are a uniquely knowledgeable and well-informed crowd and potentially critical. We have talked about the leaky umbrella at IRMI conferences in the past. Several years ago was the most recent one. And we've talked about coverage gaps that potentially exist going from primary to umbrella or excess layers. Today we are going to talk about that, but there are several other important areas where leakage, if you will, can also occur. And I'm going to spend as much time on those as on the coverage gaps themselves. I hope that doesn't disappoint you, but hopefully it'll give you a more well-rounded, I'm going to say, warning about how to look at your umbrella placements. Could I ask for a show of hands how many out there are employed by construction companies? Great, thank you. And how many by agents or brokers? Okay. And underwriters? All right, gosh, it's almost equally divided. So hopefully there'll be something for everyone. So we're going to talk about coverage gaps between primary and umbrella. We are also going to talk about the proliferation in recent years of umbrellas being written on excess, sometimes called straight excess forms, and then your own umbrella placement. If you're a contractor, the umbrella placement you put together if you're an agent or broker, the umbrella placement that might come to your desk if you're an underwriter, and what makes a good one and what underwriters are looking for. And then finally, your subcontractor's umbrella. What does your subcontractor's umbrella coverage have to do with your protection, your management of risk, your interest in plugging coverage leaks? My guess is you folks wouldn't be here if you didn't know the answer that if you're a contractor that employs subcontractors and care about contractual risk management, there are things about your subcontractor's umbrella you should know and monitor. Okay. So let's talk some about coverage gaps. First of all, probably the thing that got me interested in this whole subject of umbrella policies potentially taking away coverage that primary policies give you is a nightmare scenario that fortunately has not happened to me, but it's happened, I think, when a seven-figure catastrophic loss takes place. It's clearly going to go into the millions, and I, as an agent, have to deliver the news to my customer that good news, your primary general liability policy covers this claim. Bad news is your umbrella policy does not. And I envision that going over not well at all with a customer who is naturally going to think, it's an umbrella policy, it's supposed to cover everything. So the proliferation of broadening enhancement features to primary liability policies that I would say in many cases umbrellas have not kept pace with, and in fact sometimes become more restrictive, is really what kind of fuels my interest in the subject. So let's jump into some coverage gaps, and I'm going to start with who is insured. You all know that liability policies, general liability and auto, have a section of significant length on who is an insured. And they talk about, if you're a corporation, if you're a partnership, they go through all that. But then they also talk about unnamed parties that can be named insureds, joint ventures, LLCs, and so forth. So when you have an umbrella policy sitting on top of a primary GL and auto, it is going to have its own who is insured section. And it might correspond closely or even identically with the underlying primary coverage. but I'm going to suggest that just as often it does not. So you have to look carefully, and if your question is going to be, do I need to name everybody that I name on primary coverage, again, on the umbrella policy, it's a good question, because I can give you a couple of examples. There are umbrella forms that say, and everyone obviously named in the declarations is a named insured, entities that you maintain an interest of over 50% and are named in underlying coverage are automatic insureds. Newly acquired, and this is, I think, quoting from one umbrella policy, newly acquired or formed companies that you own 50% or more of, and that are named in underlying policies, except partnerships, joint ventures, or limited liability companies. And by the way, you have to give prompt notice of companies if they are newly formed or acquired. There is another broadening endorsement that says any organization you newly acquire or form other than a partnership or joint venture and over which you maintain ownership or majority interest will be deemed to be a named insured. But then, of course, you get to at the very end of who is insured section in most umbrellas, you get the paragraph, no person or organization is an insured with respect to the conduct of any current or past partnership or joint venture that is not shown as a named insured of the declarations. So my bottom line really with an umbrella policy is you pretty much just better name everybody that you name in the underlying. If you depend on what the umbrella might give you in the way of automatic, so-called automatic coverage for parties that aren't named, it varies a lot between umbrella forms, and it doesn't necessarily give you complete protection. So again, I think the safest thing when you have an umbrella policy form is that the named insured should duplicate what's in your underlying policy. Let's talk about additional insureds. These days, most umbrella policies have blanket additional insured language written right into the form. It's frequently broad, and it will very, very often mimic what the underlying GL policy gives you. But again, chances are it's not identical. You might get an umbrella policy that says anyone is a named insured, anyone is an additional insured with whom you've agreed contractually, and you're contractually obligated to add as an additional insured, but only for BI or PD caused by the named insured or someone for whom the named insured is liable. Well, you probably know that additional insured endorsements and GL forms have kind of gone back and forth with the caused by versus arising out of. In our agency, we run into requirements from general contractors or owners that they won't accept the caused by wording. They want arising out of because it's broader. So again, the additional insured language that you get in umbrella form is frequently good and frequently broad, but it's also frequently not exactly the same as you get in your underlying GL or auto. Another question that I've asked myself and asked some umbrella underwriters is, what does you mean? Y-O-U, you. They talk about a automatic coverage for an entity that you own a majority interest in, and one umbrella policy actually defines you as the named insured shown in the declarations and any subsidiary thereof. So clearly, you meaning the named insured, that's obvious. But what if it's the principal shareholder of the named insured who owns the majority interest in another entity? I don't have a clear answer in my own mind for that. And frequently that's going to be the case. It's going to be a sister company, and the named insured corporation is not going to be the majority owner. Sometimes it will, but other times it's the owner of the named insured, the person or the people. So again, it's a question that casts doubt on the assumption that an umbrella will follow form on any named insured wording in the underlying. So that pretty well describes the named and additional insured issue. So let's talk about some other coverage gaps potentially. Residential exclusions are out there. We all know that. You probably take pains to make sure that if there's any possibility of you doing residential work, that you do not want that exclusion on your general liability policy, and you can usually get it removed unless you're a 100% residential contractor. Then you're obviously going to be only going to markets that write residential contractors. But umbrella carriers, again, they will sometimes put on residential exclusions that the primary GL doesn't. So that's something that you have to be watchful for. I will tell you that underwriters will be reasonable at times. We have an infrastructure contractor that might pave a parking lot for a condo association or an apartment association. And we could not get the underwriter to delete the residential exclusion, but we did get it modified to apply to vertical construction or something that allowed for coverage for the likeliest exposure that this infrastructure contractor would have if they were doing under drains or a parking lot that happened to be in a residential complex. Geographic exclusions are common with umbrella carriers, because keep in mind, they think of the whole country. So they need to have their forms match up and respond to geographic areas that they are concerned about. And you will see exclusions for Colorado, Arizona, New York. And it might be a construction defect issue, it might be a subsidence issue, it might just be a state that the underwriters have decided has bad law on some issue or another. So again, where you would not look to see that on your primary GL, umbrellas may have it. And if you are, or your client is a contractor that for sure works in several states and might work in a dozen more, you really don't want that exclusion for Colorado or Arizona, because the contractor might get a job there unbeknownst to anyone. So you definitely need to be aware of geographical exclusions. Regarding perils, it's kind of the usual suspects for the most part: mold, lead, asbestos, EIFs, silica. Those are very common on umbrella forms, and of course they're common on GL forms as well. So you really just want to see that the language doesn't restrict coverage even further or broaden the exclusion further than the primary policy does, and just turn every page and scrutinize every endorsement that excludes certain perils. Aircraft and watercraft, we see a variety of responses and treatment of both of those in umbrella forms, and I'm going to address it further in a minute. The last one on the page there is delayed drop down, and that's a somewhat obscure thing that people as knowledgeable as you folks might be well aware of it, but in cases where you have an aggregate erosion and the umbrella ends up being called upon because there are more than one loss, and the aggregate of, let's say, $2 million on the primary has been eaten up. But if let's say one of the claims that eroded that aggregate was a claim that is covered by the GL but would not have been covered by the umbrella, maybe it's pollution, maybe it's EIFs, maybe it's mold, you have a problem, because most umbrella forms will not recognize a loss as eroding the aggregate and eventually getting them involved if one of those losses would not have been covered by their policy. And I don't know that I've seen an umbrella form that wouldn't exclude that. So it's something to be aware of whenever you have, if you have a large loss that's covered because you have a solid, good, broad GL form, you might need to just kind of make a note that if there happen to be some other claims, you might have a problem with where you thought the umbrella was going to attach. Pollution and professional liability exclusions are super common, obviously, on both GL forms and umbrella forms. The trick here is to see how they match up, because probably more often than not they do not. They are not going to be identical. There are 3 at least different ISO professional liability exclusions. So the chances that with a different carrier on your umbrella, you would have exactly the same language is low. They're probably going to differ from each other. And again, it's just something to be aware of, point out to the powers that be. Same thing with pollution. There are total pollution exclusions. There is the traditional ISO pollution exclusion, which actually leaves room for a fair amount of coverage, and everything in between. A hostile fire. There are a whole bunch of iterations of how pollution is excluded. And of course, most contractors should carry a contractor's pollution liability policy. But that doesn't mean that you don't want as much pollution coverage as you can get on your GL and your umbrella. Chances are between the two you have higher limits than you have on your contractor's pollution policy. So again, it pays to look at those and see how they match up. The two that I show there with red X's through insured versus insured and care, custody, and control, over the years, I would say that once upon a time, most umbrella quotes that I would see as an agent would have an insured versus insured exclusion. It would have a CCC exclusion. And we and others have fought to limit those exclusions to named insured versus named insured, so that a claim from an additional insured, who is typically a likely claimant, if there's going to be one under a liability policy, that claim does not get excluded. And anymore, we almost never see umbrella policies that have true insured versus insured. They now almost always do named versus named. And similarly with care, custody, and control, when umbrella policies would put on a blanket CCC exclusion, they took away a fair amount of coverage that the old broad form PD, which is now written into the primary general liability policy forms, would give you. And again, it's not uncommon anymore, or nowadays, for umbrella policies to follow identical language to the primary GL in the exclusions that reduce the restrictive exclusion of care, custody, and control. But it's not guaranteed, so you need to be on the lookout. If you see a care, custody, and control exclusion, you need to see if you can get it modified to follow form what the primary GL will do. So a couple things that I wanted to look at actually with a policy. This is an ISO umbrella form. I think it's the 2013 form. And you can't really see the policy language there, but I mentioned aircraft liability. It had been my working assumption that umbrella policies basically really did not give any aircraft liability coverage, and they certainly do not intend to provide any owned aircraft liability coverage. But there are a couple of exclusions, there are a couple of exceptions to the exclusion. One that I've circled there is liability assumed under any insured contract for the ownership, maintenance, or use of aircraft or watercraft. And then the one at the top of the second column, which I didn't circle, also says the exclusion does not apply to aircraft that is chartered by, loaned to, or hired by you with a paid crew and not owned by any insured. So those are exceptions to the exclusion that could give you a pathway to coverage if, let's say, you as a contractor own a plane, but you don't own it. You have a separate entity that owns it, that buys aircraft liability insurance. But as we know, it can be challenging to get high limits for owned aircraft liability insurance. It's very rare that you would have as much insurance on that plane. It would be expensive to have as much on the plane as you have in your standard program. But if the plane is owned by an entity that is not a named insured and has its own aircraft liability policy, and then that plane is leased or chartered to the named insured, I would suggest that the way these exclusions read and the exceptions to them, there might be non-owned aircraft liability coverage, at least under certain circumstances. And certainly I don't know that underwriters would believe that they're giving non-owned aircraft liability, and certainly they would want to be informed, obviously, if there was any exposure. So if there's a plane, if it's owned by another entity, my thought would be there should be a contract by which the named insured leases it. There may be a formal charter, and there should be indemnification language where the named insured indemnifies the owning entity of the plane, and doesn't replace owned aircraft liability, but it's a way to potentially have higher limits available to the named insured. Okay. The other thing I circled there was down at the bottom of the second column was, and again, this is from the umbrella form that follows form on the underlying limitations to the care, custody, control exclusion. So those are just things that are essentially broadening features in standard umbrella policies today. Now, this is also a page from the same umbrella form, and in the additional insured section, it gives additional insured coverage, broad as primary, and basically does follow form what most, I say most, what a lot of primary general liability policies give. It also follows the wording that we see almost universally now that says regarding limits, you get the lesser dollar limit of what you require or what the upstream contractual party requires and what the policy actually gives. So if you've got a 10 million umbrella but the requirement is only 2 million, you're only getting additional insured protection for $2 million. And here's that pesky paragraph at the bottom: no person or organization is an insured regarding the conduct of any current or past partnership, joint venture, or LLC. And I'd love to know why they include partnerships or LLCs there, since so many entities today are an LLC. That's a lot different exposure to me than a joint venture is. So I would think if you can get that paragraph to read just joint ventures, you would certainly be kind of ahead of the game. Okay. And then this is also just, this is the damage to the work exclusion O. And again, this is an example of a current ISO umbrella form that follows form over the underlying CGL exclusion, including the carve-out for subcontracted work. So this is how umbrella policies have closed the gap and gotten rid of the CCC, blanket CCC exclusion. Okay, we're going to talk about umbrellas versus excess forms. First of all, I'd like to see if, maybe I'm out there on an island, but if you are a contractor and you have a straight excess form versus an umbrella form, if you happen to know, raise your hand. You know? A few? Okay. We have found, maybe in the last 5 years or so, straight excess always used to be what you'd get on the higher layers. You'd get an umbrella policy and you got all the good things that an umbrella gives you, and then you would move into straight excess. But we have found that excess forms, as opposed to umbrella forms, which basically, as you probably know, an excess form is short, it doesn't have a lot of pages to it. It essentially says, we are insuring what's insured in the policy underneath us, except where we say we don't. And we're insuring the entities that are insured in the policy beneath us, unless we say we don't. So there are some positive aspects and some negative aspects to both umbrella and excess forms, and we'll examine them for a second. So umbrella, pro, covers everything, right? It's an umbrella. It also drops down to first dollar to cover claims that are not insured by the underlying policy, and that's where you'll see the self-insured retention, which a lot of people that aren't in this room, but contractors that might not be as don't have the expertise, think that that self-insured retention is sort of a layered deductible between the million and when the umbrella comes in over the million, and it's not. It's a deductible for claims that the umbrella has to drop down and cover first dollar. So again, that certainly furthers the idea that an umbrella policy is obviously broader than the underlying coverage. That's the idea it conveys. Another good thing about the umbrella is it will have enhancements that an excess form most likely would not. And I cite crisis management response. It might have a limit of $250,000 or some amount of money that is made available in a catastrophic loss to pay for a crisis response, a public relations firm or They will list a broad array of dollars available to come to your assistance in the event of a catastrophic claim. It's a great thing, and it's certainly a positive aspect of having an umbrella. On the con side, being a whole new form, it is its own policy with its own conditions, limitations, exclusions, declarations. So nothing really can be assumed. You have to read that form and every page, every word of it, really, to fully understand how it sits on top and where it sits on top of the underlying coverage. And as we've discussed a little bit, there are places where it might be broader. There are other places where it might be narrower. So it must be scrutinized. Now let's look at an excess form. On the pro side, it mirrors the underlying terms except when stated otherwise. It's easier to review because it basically says we're just like what we're on top of except where we say we don't. So there's a couple things about it that are clearly advantages. On the con side, you have to make sure you scrutinize just what is stated otherwise. If it's going to have exclusions, you absolutely have to understand them completely and understand where it is not following form and it does not do what the underlying coverage does. It is much less likely to have enhancements like crisis management response. You're not going to get that. It's going to be a plain vanilla, basically just saying we do what the coverage underneath us does, no more, no less. Another con is it looks like an umbrella, but it is not. What do I mean by that? You might get an insurance certificate from a subcontractor that, and I will say that the Accord certificate does not, in the umbrella section, there's a box to check of excess versus umbrella, and you should never trust that box, the check in that box, because it is frequently not, like we have a lot of umbrellas in our agency that are written on an excess form now, and the umbrella box still gets checked. So when you are looking at a certificate from a subcontractor, for instance, that excess box might be checked, but the certificate won't tell you that excess policy sits over the general liability, but not the auto. And we've seen a bunch of those. So you need to, sometimes excess policies are written because you might get broader coverage than an umbrella. Sometimes they're written because the underwriter does not want to go over everything that's underneath. So they say we're excess of this and we're excess of that. We're excess of the employer's liability, we're excess of the general liability, period. And that's all they really have to say. They could exclude auto, but they don't really have to. All they just have to say is we're only going over these policies, and they leave one out. And we've seen some insurance certificates that will clearly state that, others that do not. All right, so we've talked about coverage gaps. We have talked about excess forms versus umbrella forms. Now let's talk about your umbrella placement. If you're a contractor, it's for the umbrella that's going to cover you. If you're the agent or broker, it's the umbrella that you are going to market and negotiate and place. And if you're an underwriter, it might be the umbrella that you are going to underwrite and kind of sign your name on the dotted line and give terms and conditions. So it's important. I'm calling these information leaks. I believe that we as agents and brokers are not, I hate to use the word sloppy, but we are not as careful and as thorough as we should be in creating and submitting umbrella applications, umbrella submissions. That is a really critically important submission, and all the bases have to be covered. And if they're not, one of the things that can happen is you get an unpleasant surprise down the road. One example of this might be if you've been sloppy about payrolls and revenue, or you've been sloppy about underlying premiums, or you've been sloppy about vehicle schedules. The next time around, you might have to give more evidence and documentation of what those numbers were, and underwriters will see that you were wrong. And at the very least, you're liable to get a big premium jump if in fact you've erred on the low side or the conservative side, and the contractor will not be pleased when they had no reason, their primary premiums are the same as expiring and the umbrella's up 40%. Why did that happen? So you do not want unpleasant surprises, and you want to give underwriters what they want. I had the privilege of meeting with a couple of umbrella underwriters about 90 days ago, thanks to our wholesale broker, RT Specialty, that we do most of our business with out of Chicago. And we spent a couple hours together, and I learned a lot about what umbrella underwriters are looking for and how they kind of do triage on a submission and how they make decisions that they make. And it was very enlightening. And these are two underwriters. I'm not going to name the companies, but two of easily the top 10 probably excess and umbrella underwriters in the country. So I'll get into a couple more things that they said in a minute. But looking at the application, you probably, if you're agent or broker or underwriter, you probably see the Contractor Supplemental application. And more often than I'd like to admit, we submit, let's say, a renewal, maybe it's new business, umbrella submission to the marketplace, and everything's cooking along, and we're looking for quotes to come in, and then we get this request, oh, and we need the Contractor Supplemental app for the umbrella. And now it's not very long before you're going to present, and you're scrambling around trying to get a whole bunch of information that isn't always easy to get. And I would suggest to you that the Contractor Supplemental application ought to be the very first thing an agent or broker puts together. It's information that is available. It's kind of blocking and tackling in a lot of ways. It's historical payrolls. It's historical revenues. It's a project listing of maybe projects completed and projects underway. And then it's a recitation of the kind of work the contractor does. It's critical information. And when we as agents and brokers leave it to the last minute, we don't do justice to anyone. So that's a strong suggestion I'll give is get started on that and get it into the underwriters right away. So talking about the exposures, again, this is blocking and tackling, historic revenues, easy enough to get. And if you, as an agent or broker, happen to do the surety bonds for your contractor, that makes it all the easier to get this information. You've got financial statements that give you revenue, subcontracted amounts, you've got project listings and a WIP report. So there's no excuse for not being able to get your hands on this information and share it with underwriters. Payrolls by class and state are important to have. Underwriters care about what state contractors are in, so it's important that they get a breakdown of payrolls by class, by state. Payrolls, workers' comp versus general liability differentiation. That can be a big misunderstanding sometimes between contractor, agent, wholesaler, underwriter. The number $14 million of payroll gets put on an application, and that gets to the wholesaler and to the underwriter. And of that 14 million, 6 million is clerical, but the underwriter doesn't know that unless they've got payrolls by class and by state differentiated. So if you just throw a number out there, it's liable to artificially inflate the exposure in the eyes of the underwriter. So you always want to make clear that you're giving you're giving payrolls by class, and if you've got non-GL payrolls, which I mean clerical 8810 and 8742 payrolls, you clearly give those so that underwriters know what the really the field payroll is, minus payroll that isn't included in GL rating. Subcontracted amount, obviously an important number to just make sure that you give and that underwriters are well aware of. And power unit count and distribution, private passenger, light, heavy, truck tractors, etc. That is a really important piece of an umbrella submission, and it's gotten more so. I'll get back to that in a minute. But then let's talk about loss run and claim updates. Really important, and again, as agents and brokers, I'll point the finger at ourselves. Sometimes we're careless in terms of making sure that we include in an umbrella submission 5 years of losses and loss runs that are currently valued for all those 5 years. This is a piece of cake these days with all the online Most of the insurance companies, you can simply go to the website and get them. It becomes a little more challenging if you've changed carriers and you have to go back to a prior carrier to get loss information, but it needs to be done. I mean, it's really, especially on larger risks, underwriters, their hands are tied if they don't have a clear picture of what the losses have been. 5 years is really the minimum. Underwriters told me that they love to get more than 5. If you can get 6 or 7 years, why stop at 5? And the reason that pops into my mind, I won't say that I've done it, but I probably have been guilty at least once of going back maybe a 6th year, and I'll stop there if the 7th year is bad. I might go 7 years if the 8th year is bad. So underwriters should be aware of that. If I was an underwriter, I think I'd always say, give me one more year, because that might be where the $1 million claim was. Not saying I did it, but updated loss runs are critical, and updates of specific claims, open and closed, are critical. There might be an $800,000 claim out there, and every claim has a story, and the big ones especially do. So you really want to tell that story in your submission. Give a paragraph on what happened in the claim. What did the insured learn from it, if anything? Was it a fluke that could probably never happen again, or is it indicative of other claims that could be similar? Underwriters really like to get that information and get the story behind the claim. A couple more bits about information that underwriters gave to me when I met with them. Before I get to that, let me just say, on the vehicle schedule that you give to the underwriters, it's this innocuous little part of the Accord umbrella app. Most contractor supplementals that I've seen actually don't really ask for a breakdown of vehicles by class. But right here on the Accord umbrella app, what's in that circle is really important information to the underwriters. And as agents and brokers, we've been careless about being exact with it. But I know that some underwriters, they want a vehicle schedule, they want vehicle numbers, and we've been contacted by an umbrella underwriter saying, vehicle number 127, the VIN is wrong. And that's because they enter all that data, and I guess it confirms that, because the VIN will categorize different numbers within the VIN, will tell you what kind of vehicle it is. And that's how much certain umbrella underwriters and their carriers scrutinize exactly what's going on with the auto schedule. Underwriters have told me the more big rigs you have, the worse. That's probably pretty obvious. The larger the radius of operations, the more difficult it becomes to be competitive, or the more they're going to charge. I guess I put it that way. They look at things like a fleet safety program. They look at the SAFER system, if you've heard of that, SAFER, I think is how it's spelled. Truckers subscribe to that, and it's anyone can plug into it and find out information on truck losses. So umbrella underwriters say that most of their losses that they pay are arising from auto accidents. So they are scrutinizing auto more than they ever have before, drilling down, asking tough questions, not always tough, but sometimes just simple stuff, but they are much more interested in the auto. I would think it won't be long before umbrella underwriters are asking for $2 million underlying before they want to attach. I know it's happening in some places, but they've been attaching over $1 million for decades, and a lot has changed in that time, and verdicts have gone up, judgments and settlements have gone up, so certainly that day may not be far behind. So you need to, if there's a claim, you want to tell the story. You want to make sure underwriters have a clear idea of what the loss picture has been, both collectively and regarding individual claims that are large. Okay, so talked about coverage gaps. We've talked about your own umbrella placement and how important it is, and how important it is to put a good submission together. Start with the contractor supplemental. Oh, one other tip: in the electronic age, it's instead of scribbling out that contractor supplemental app and making it barely legible, it's wonderful when those are forms that the carrier has a form fill where you can type on it, and it's first of all, it's easier to read. Secondly, it's a document you have and you save it in Word form, you keep it, and then next year, when next year rolls around, you can start with that and just update it and make changes. That certainly can ease up on the, reinventing the wheel every year with that really important information. Okay, when you subcontract, I'm guessing that most of you, if you practice contractual risk management, and I'm sure you do, or if you're agents and brokers, you help your insureds do it. You pay a lot of attention to your subcontract agreement, the indemnification language that you get, and the insurance limits you require. And in this day and age, I'm guessing that a lot of your subcontracts require more than $1 million of coverage. And they might require it a lot of different ways. They might not specifically ask for excess or umbrella coverage. They might just say, you got to give us $3 million in general liability and $2 million in auto or whatever. But I would suggest that the time is past when you can settle for $1 million limit from your subcontractors. Obviously, there might be exceptions and business decisions to make, but so given that you are going to be requiring more than $1 million of coverage from your subcontractors, it kind of opens up a whole new world of monitoring the coverage that they give you. We all know that good, effective contractual risk management with your subcontractors is kind of a two-part process. One is writing good requirements, and these days, with all the changes that have happened in additional insured endorsements and so forth, I would suggest that if you haven't looked at your subcontract in a couple of years, maybe even in just a year, you probably want to look at it again, because things like, a lot of additional insured endorsements say that you only get premises and operations unless you specifically are obligated by written contract to give additional insured completed operations. So in your subcontract, you now have to require specifically completed operations, or you won't have it in a lot of blanket additional insured endorsements. That's just one example of why you need to almost annually be looking at your subcontract insurance requirements and seeing that they're as up to date as they can be. So we're talking about subcontractors. Suppliers is less of a critical issue, since suppliers are rarely on your job site, but it does bring up the issue of purchase orders. Purchase order is a contract. You've all seen the carbonized forms that have all the important elements of what's being bought and sold on the front, and on the back there's about 18 paragraphs and 1,000 words in gray lettering you can barely read, and somewhere in there are maybe insurance requirements or indemnification. But when you work via purchase order, be it with a subcontractor, maybe you're a subcontractor signing a general contractor's PO, maybe you're renting equipment and a PO gets signed, those can be important insurance requirements as well that you need to pay attention to. And in your purchase order to suppliers and maybe certain subs that you work with PO on, you want to see that you are satisfied with the protection you get, both contractually and from an insurance standpoint. Truckers, to me, is a whole another subject, and we deal with a lot of excavation, earth moving, paving contractors that have a whole bunch of trucks of their own, but they also hire trucks. And to me, there's chasing down insurance from subcontractors, and then there's chasing down insurance from truckers. And truckers is truly herding cats, at least in my world. There, you see every form of, many different insurance companies, many of which I've never heard of until I see them on an insurance certificate. You see frequently with truckers. In my world, I've done a lot of helping clients in Florida that use a lot of truckers, and maybe Florida's unique, but I kind of doubt it. You will see a lot of truckers that will not have the any auto box checked. And we tell our client that if you don't have any auto, what you want is the owned, non-owned, and hired boxes checked, and they aren't checked either, and it's scheduled autos only. And when it's scheduled autos only, that's not anywhere near as broad, and you have no way of knowing unless you get a copy of their policy which autos they are insuring. So there are a lot of issues with managing the risk of truckers that work for you. And we've got a customer that the worst loss they've had in the last 10 years it involved in fact, there were two losses. Both of them involve truckers that committed serious acts that caused serious bodily injury, and in both cases there was less than complete insurance and indemnity protection. So it is vitally important to manage the risk of your truckers and all of your subcontractors. Okay, talked a little bit about as you monitor compliance with subcontract requirements. You want to, I mentioned checking and making sure the right box is checked. And we've got a customer that actually has gone to requiring a copy of the umbrella or excess policy to be included with the certificate. And believe it or not, it surprised me, but they're getting them. The subcontractors or truckers will actually give them a copy of their umbrella, and they'll send it to me, and I'll look at it. You find some interesting things on those umbrellas. That's where I found that it was an excess policy that, although nothing was said about this in the certificate, it did not cover excess of auto, only of general liability. And this was a trucker, so it was the auto that we really wanted. So you need to pay attention to that. The other interesting things you can find if you actually get a copy of your subcontractor's umbrella is exclusions of drivers. I've seen umbrella policies that exclude specific drivers that I'm guessing might still be driving for the subcontractor. So that would be a sort of a major no-no. So, and then confirming your additional insured status. Again, we've talked already about the fact that there are a lot of different additional insured endorsements, and a lot of insurance certificates will say they will have some language in there about additional insured, but we all know the wording that's at the top of the Accord certificate is this does nothing to alter or affect the coverage. You have to go to the policy for that. So it has become our universal recommendation to contractors in looking at their subs insurance that they put in their subcontract that they need to get, they say what the requirements are, and that you will give us a certificate and a copy of the additional insured endorsement that confirms our status as additional insured. And we usually get it. Sometimes it takes a second request, and I've probably seen 50 different additional insured endorsements over the past couple of years. So you just never know for sure what it's going to say. I've seen where the additional insured endorsement says any party you've contractually agreed to name as additional insured, but only for acts arising out of your negligence. Well, I mean, you kind of have that already. So if you're only additional insured when the named insured is negligent, that doesn't give you that doesn't give you anywhere near as much protection in tendering a claim against you back to that subcontractor. So strongly recommend having the subcontract stipulate that a copy of the additional insured endorsement will accompany the cert. And then of course, what about the umbrella? We've already talked about the fact that you don't know for sure what the umbrella or excess is going to do. Are they going to follow form additional insured? And I will say that umbrella policies have gotten better at that. It's fairly rare that we find umbrella policies not having blanket additional insured embedded in the form, but it isn't universal. So it's a pain, but independently verifying your additional insured status into the umbrella layers, if you require umbrella from your subs, we feel is worthwhile. Maybe it's spot checking and just understanding that some forms do it and keeping a record of those, but it is worth it to keep tabs on how your additional insured status manifests itself on excess and umbrella policies. Monitoring strength of and quality of your subs carriers. It's really great when a certificate will actually give the best rating of a carrier. We don't see it too often. It's also good when they'll put that NAIC number, so you can easily look that up. But again, and I'll bring truckers up as an example, there's a lot of small insurance companies that insure truckers, and some of them are not rated A or A minus. So it's important to do that. And again, I've seen the same thing on umbrella carriers where some of them this is more in the excess field, but there might be an obscure carrier that may not have a good rating. So that is another area that is worth checking. So I'm going to go back to a couple of examples of that underwriters gave and that we had with insureds that we were working on a renewal with, where a contractor had a large loss, and it involved a trucking subcontractor where the trucker had disobeyed his direct orders and turned in a median of an interstate freeway to go back to get another load at a road construction site on the freeway a couple miles back. And the turn was actually not made in the work zone. It was made beyond the work zone. But that trucker caused a very serious accident, was clearly negligent, cut across 3 lanes to make his turn, and a vehicle, they had a collision with a vehicle where there was closed head injuries and permanent injuries, basically, that were clearly going to be 7 figures. And at first, we really thought this wasn't going to involve us because it didn't happen in the work zone. It wasn't our truck, and it shouldn't be a claim against us. But pretty soon, the claimants recognized that the deep pockets were the prime contractor on the project, and our insured was brought into it. And what resulted was a claim that actually turned out to be a general liability claim, not an auto claim, because the allegations against our insured were that they failed to adequately supervise this trucker and didn't instruct him clearly, and that was contributed to the cause of the accident. So depositions were taken, and there were several lessons learned on the umbrella and excess side from this claim. Lesson 1 was in the taking of depositions, several of the insured's employees were deposed, and they had some things to say about the insured's attitude toward safety versus productivity. It was mentioned in our keynote address today. That didn't reflect well on the insured, and surprised the insured, because I happen to know this insured their focus on safety is phenomenal. It's very strictly enforced, and the culture is great, we thought. So that was a lesson for the insured. Another lesson was the defense counsel for the primary carrier was a local law firm in Florida that was handpicked by the insured and approved by the carrier, the primary GL carrier. And that defense counsel got their head handed to them from the plaintiff's attorney in this case. They were outdone at every turn, and this is in the assessment of the insured who had hired them. So they realized that the quality of your defense counsel is incredibly important. But the other lesson has to do with when you have one carrier on the primary and one carrier on the umbrella or excess. This was a claim that we were essentially excess over the $1 million auto policy that the perpetrator of this accident, the trucker, had, but that's all they had was $1 million. And then came our $1 million of primary liability, and then the umbrella. And when it became clear that the plaintiff's counsel was basically saying, if we don't settle this for $7 million in the next week, our number goes up to $12 million. And that could be just posturing, but it was credible posturing, I'd say. So it was time to settle the case as best it could be settled, and the umbrella carrier, actually, and it was an excess policy form, had stepped in because this was now going to be mostly their money, and they were acting responsibly and wanting to settle the thing as best they could. And meanwhile, the primary carrier was digging their heels in, saying, we're not ready to settle this because the trucker's $1 million is up, but we shouldn't be next. The trucker's corporate assets should be next. And it's a fair point. The trucker's responsible, and just because their insurance runs out doesn't mean their liability runs out, and we all agreed with that. But the fact was the trucker had basically thrown the keys in and said, I'm done, I don't have any assets, and essentially closed their company. So there really wasn't anything to go after there, but the primary carrier adjuster kind of continued to press that issue when time was running out. And it's certainly that adjuster had a point to make. It was a little late in the game to be making it, but my overall thought about that is it's a potential problem of cooperation between the primary carrier and the excess or umbrella carrier. And it gets to the point of, do you want to have one carrier on your auto and general liability and another carrier on your umbrella or excess? And it's a tough call. I mean, there are times when you do, there are times when you have to, but there is an advantage, I would suggest, of having the same carrier on your umbrella, or at least your first layer of umbrella, as writes your primary. You're more likely to get coverage that's going to dovetail, and you're much more likely to get cooperation in a claim. We've seen cases where when you have different carriers, that the umbrella carrier will try to say that a catastrophic situation isn't one occurrence, it's multiple occurrences, so that their limit hasn't been met on an occurrence basis. We think it's a $3 million claim, and the umbrella carrier thinks it's six $500,000 claims, and they haven't hit the aggregate yet, so you get in a fight that way. So there are certainly advantages to having the same carrier on your umbrella and your primary. Now, we find that most of the time in those cases, those carriers will not write an excess form. They want to write an umbrella form over their own primary. And we've already talked about the pros and cons of excess versus umbrella. There are certainly pros and cons each way. But, you kind of have to pick your poison, and I would say that it's if an insurance company will write umbrella coverage over its own primary, they're going to be hard to beat competitively from the wholesale umbrella market. Probably they'll probably have a better price, but again, we as agents and brokers can't be blinded by that. We have to look at the coverage as well. Okay, let's wrap up. Coverage, form, information, and protection. That's kind of the words I've ascribed to the four parts. On the coverage side, where there might be gaps between primary and umbrella or excess, take nothing for granted. You have to scrutinize, especially an umbrella form, to make sure that it is as broad as it can possibly be and as broad as your underlying primary coverage is. And if it's not, you need to know why, and all the parties need to be aware of that, so we don't have an unpleasant surprise later. Regarding form, umbrella versus excess, I've tried to kind of point out the pros and the cons. There's some really good things about having an excess form on what has otherwise been an umbrella policy, I think, because named insureds and perils covered are going to follow, except in cases where they specifically say they won't. But again, the umbrella can give you crisis management response and other things that excess policies usually don't. Information. Start with a great submission, up-to-date, currently valued loss runs, and a contractor supplemental. And as I said, save last year's, have it be a Word doc you can go in and just kind of tweak so you don't have to reinvent the wheel every year. And I think having spent some time now with underwriters, it's pretty clear that they play favorites in terms of the brokers that they deal with, and then the brokers play favorites with the retail agents and brokers they deal with. And my goal, as being an agent broker, is to develop a solid reputation for giving a thorough submission to the market on a timely basis. And that's really the tools that they have that allows them as brokers to go out and deal with their underwriters in a way that will get the best terms. Protection, if you care about contractual risk management and you believe that $1 million probably isn't enough of a limit, then you must pay attention to the details of your subcontractor's umbrella policy. That's all there is to it. It's important that if you feel like you need to have more than $1 million in limits from a subcontractor, supplier, trucker, that you want to know what kind of coverage they have after $1 million. Thanks. And if there's questions, we have a couple minutes, I think. I don't want to stand between you and lunch, so. There's one right here, Jeff. Behind you.
In a soft market, are you seeing the coverage forms, coverage gaps, et cetera, being relatively elastic or inelastic?
Glad you asked, because I had intended to say that the underwriters did mention that if you are looking for modifying language to what they are going to put out there in terms of form and endorsements, make your case. So, at times in the past, they might have been take it or leave it. In a market that is softer, they have said, tell us what you're trying to accomplish coverage-wise, and we'll see what we can do. So I would say somewhat elastic.